How's it going, everybody? It's Adam from Flagship Home Loans, and I get asked all the time, should I refinance right now? The better question is, when does refinancing actually make sense for you? Let's break that down. Refinancing isn't about chasing the lowest rate. It's about strategy, okay? First and most obvious reason is to lower the interest rate. The most common reason people want to refinance is to lower that interest rate, but it's not the only reason. Lowering your interest rate can reduce monthly payments. It can also reduce the life of the loan as far as the term. It can reduce and save thousands of dollars in interest over the life of the loan. But rates alone don't tell the full story. Closing costs do matter. More about that later. The bottom line is we have to come up with a strategy that makes sense for you. Okay. Second reason we might want to consider refinancing is a monthly cash flow reason. Money matters, right? And another big reason to refinance is improving the monthly cash flow. We can extend the loan term to lower payments, not just lowering the interest rate, but stretching it back out over a lower term can lower monthly payments. Switching from an adjustable rate mortgage to a fixed rate loan could be a good idea. And also removing or updating mortgage insurance is another way to lower those monthly payments. And sometimes it's not about paying off the house faster. It's more about breathing room, okay, with that cash flow. Third reason is cash out refinance. Now, if your home value has gone up, refinancing can also allow you to dip into some of that equity and make it work for you. We could do debt consolidation, pay off high interest rate credit card bills, free up some money that you can put back into the house and not just waste on credit card debt. Home improvement, major life expenses can be dealt with. Financing, I've even had people refinance and get cash out to pay for schooling. Bottom line, though, is that it's not about pulling cash out just to spend, okay? It's about using that equity with intent, okay? Where are we going to take that money to pay off other money or other debts that are at a higher interest rate or higher monthly payment? That's key. The fourth thing is a loan structure and life change. Life changes and your mortgage should keep up, right? Going from a 30-year to a 15-year to build equity faster drastically reduces the amount of money that you are paying per month towards interest. Yes, your monthly payment does go up, but it cuts your interest per payment down to a fraction. You have much more of your monthly payment going towards principal, but not all of us can afford those monthly payments. Also, if you're planning to move in a few years, right, we want to take that into consideration. If we're doing a refinance right now that saves us $200 per month, but it might be $500 or $5,000 in closing costs, if we're moving in a year and a half, are we going to recuperate that money? Got to keep that in mind, right? So again, the key here is the right refinance depends on how long you plan on staying in your home and what your life goals are. The fifth reason we want to take into consideration is the break-even point, which I just commented on there. However we're doing this, whether we're doing debt consolidation or whether we're doing term reduction or just trying to reduce the monthly payment, it has to make sense within the time frame that you're going to not just own the home, but be in the mortgage. If we think rates are going to be lower 2 years from now and it takes 48 months to recuperate the closing costs, we're going to be leaving some money on the table if we refinance right now. But nobody has a crystal ball, right? So the one thing I always look for is a good break-even point. And it does take a loan officer to break that down for you to evaluate what that break-even point could be or what it really is. We're looking at true savings. We're not looking at things like taxes and insurance. If taxes and insurance went up, that's not actually increasing your monthly mortgage payment. That's just increasing your total obligation. So we want to look at savings for principal and interest over time. How long does it take for the monthly savings to cover those closing costs? Or if we are reducing the term of the loan, how long until we get back to the starting point or the loan amount right now when we roll in those closing costs? That's how we figure out the break-even point when we are reducing term. If you're moving before those break-even points or just going to refinance out of there, it doesn't make sense. Timing matters just as much as rate and costs. So the call to action here, folks, is interest rates are a little bit lower right now. It's worth looking into. I have many people that are able to recuperate their closing costs within a year or two. 100% of the time, I'm going to recommend that we do a refinance if we're able to recuperate the closing costs within a year. So when's the right time to refinance? give me a call. Let's talk about it. What are your goals? And not just looking here to reduce your interest rate, but let's try to hammer out a few things. Let's try to pay off some debts. Let's reduce the term of the loan and save you money on a monthly basis. If we can do those three things together, that's a win-win-win in my book. So hope everybody is having a great day, and we'll see you again soon. Take care, everybody. Thanks.